What I'm going to do today is give you $7 targets, seven end game dollar figure targets for the silver price, ranging all the way from $118 all the way up to $3,002. And
I am preaching that right and left these days, that these silver stocks, they've moved a good bit, but these junior silver stocks are the most explosive area I see going forward. We had a little run in the spring of 2016, and across the board, they all quadrupled and quintupled over
Really?
6 months. Over 6 months, they can move and will move. And again, silver's popped over $40 today on a spot.
This year, investors have poured money into gold, seeking safety and certainty amid tumultuous equity markets and a plummeting reserve currency. However, while gold has undoubtedly performed well this year, investors may be surprised to learn that it has not been the best commodity to invest in for 2025. Silver has shattered the crucial $40 barrier, reaching $40.57 per ounce as of September 2025, a level not seen in 14 years. This remarkable 45% year-to-date increase has caught the attention of both seasoned precious metals investors and newcomers to the market. The total annual silver market is valued at approximately $25 billion compared to gold's market of over $180 billion. This relatively small size means that even modest capital inflows can significantly impact silver prices. Market analysts estimate that a $1 billion shift from other assets into silver represents about 4% of the annual market, enough to meaningfully influence price discovery. The current price of silver is a total lie. Market specialist Rafi Farber sees a shocking floor for silver, with targets starting over $100 per ounce. He points to historical gold-silver ratios and other key metrics that show even the most conservative estimates put silver's value significantly higher than it is today. Rafi Farber warns that if silver returns to its historic 1980 ratio with the S&P 500, the price could skyrocket to nearly $3,000 per ounce. This isn't just a number, it's a testament to what happens during a true monetary panic. In such a crisis, derivative assets like stocks lose value much faster than tangible commodities, which is why silver could see a dramatic revaluation. Analysis of silver price performance over the past 20 years reveals that the period from September to November has provided positive returns approximately 65% of the time, with average gains exceeding those of the summer months by nearly 2 percentage points. Before we dive into Rafi Farber and BrienLundin's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Money itself. So the answer is that all the silver now accessible by people above ground will be exchangeable for all of the wealth on the planet. What that dollar figure exchange rate is could be anywhere from $118 to $3,002 based on today's monetary metrics, which change daily. But let's get into it. The 7 targets for the silver price, starting with the CRB adjusted ounce target of $118. CRB adjusted means we're going to take the silver ratio to the CRB commodity index, its lows, meaning how many ounces of silver did it cost to buy one basket of CRB commodities. The CRB commodity index is an index that's been around since the 1970s, I believe, or even earlier. I think it was interpolated earlier, but it started to get use in the 70s. The low for this ratio means the least amount of silver ounces that a CRB commodity basket was worth was, of course, in 1980 at about 8 ounces. Well, you see here where it says last 20.22. So if we go down to 7 or 8 and then we multiply that factor by the current silver price of $41, we get $118 per ounce of silver, but this is the lowest dollar amount. CPI adjusted ounce target. If you adjust for CPI, a lot of people are fans of this one. I'm not a particularly big fan of this ratio because the CPI itself is adjusted and manipulated and doesn't make much sense and is very subjective because people buy different things. But anyway, the high here for 1980 relative to the CPI going back to 1800 or interpolated back then, which is all an estimate because nobody knows exactly what the prices really were back then. But anyway, the high was $172.54 CPI adjusted silver ounces in 1980. But that target I don't really like, and I don't think it's realistic. I think it's way too low. The Dow Jones Industrial Adjusted Ounce 2011 target for silver. So we're going to take the Dow Jones ratio to silver back at the 2011 high. This is not the 1980 high. That's a separate chart. We're going to get to that in a minute. The 2011 high was at about 250 ounces of silver for one Dow Jones Industrial unit. And we are at 1146. You can see here, this is the first bubble of stocks, major bubble relative to silver, peaked in 2001. This is the second bubble. It's been wobbly since about 2017 or 2018 top over here. And we've been heading down since then in jagged little edges. But I think this bubble has peaked in 2017 or 2018, whenever that peak happened to be. If you take the 2011 top in silver ounces, 250 ounces per Dow Jones Industrial average unit, 1146 to 250, take that ratio, multiply it by 41, and you get a target of $188 for the 2011 silver high relative to the Dow Jones. This is much more realistic. Now, if we reach the 15 to 1 gold to silver ratio, which we will at the current gold price of about $35.50 over the weekend, that leads us to about a $236 target for silver if the gold dollar ratio doesn't move, which of course it will. Anyway, here again is bubble one of stocks relative to silver. Here is bubble two. And so if we take the 2011 top at 25 ounces of silver per S&P 500 unit, we are at 162 now. We were at 25 then. Take that ratio, multiply it by 41, and you get $265 an ounce of silver if we reach the 2011 highs relative to the S&P 500. But let's go further still. And now here's where we take a quantum leap. The Dow Jones Industrial Adjusted Ounce 1980 target of $2,676 an ounce. Why is that? Well, if we look at the silver to Dow Jones Industrial ratio, remember the chart a few slides ago where we took the 2011 top. Now we're going to take the 1980 top. We're going to reverse the chart so we can see it better. The top of silver relative to the Dow Jones Industrial ratio was 57. This, of course, is the ratio times 1,000, just to give it better, easier to do math numbers with. So if we take the ratio and multiply it by 1,000, we are at 0.873 now. We were at a high of 57 back in 1980. So if you take 57 divided by 0.873 multiplied by the current silver price of $41, you get a target of $2,676. Now let's move to the final target for silver. This is the S&P adjusted ounce 1980 target is $3,006. How is that? Because the ratio of silver to the S&P 500 index is now 0.006. You can see we've had an amazing rally in 2025. You can see a tiny little bump up. Look at that. It's amazing. What a rally. Silver is really tearing people's faces off. Is that the expression? Not really. Not yet, but it will. But if we take this number and the peak here is at about 0.43, that's where the red line shows, maybe 0.44. I think it was actually 0.44. So if we take 0.44 divided by 0.006, multiply it by the current silver price of $41, we get $3,006 per ounce of silver. Now you could ask me, why do the silver to stocks ratios jump up so dramatically relative to all the other ratios? What is the deal here? I would say that 1980 was a true monetary panic. And in monetary panics, The top derivative layers of the pyramid fall the fastest, and all the purchasing power from those layers of the pyramid gets destroyed the fastest. If you have something like the CRB index, which is a collection of real commodities, or the gold to silver ratio, which gold will only go down to about 15 to 1. The Dow Jones and the S&P 500, by comparison, are a measure of derivatives, things that are not money, that are farther away from money than, say, commodities are. And the CPI, for example, is the consumer price index, how much it costs to buy real commodities. And so those things are not going to fall in value because you need them relative to stocks, which you don't because they're just derivatives. And when derivatives fall because credit falls, their purchasing value goes down the fastest. So this time, I think we're going to get closer to the $3,000 targets that we saw hit in 1980 in the Dow Jones and the S&P 500, because it is the top derivative layers of the pyramid that will fall in purchasing power the fastest.
Financial advisor BrienLundin explains that in the current scenario, the buyers are central banks, not Wall Street. This has left silver and mining stocks lagging behind, creating a generational opportunity. Most people believe we are late in the gold bull market, but BrienLundin says we're only halfway through. While central banks drove the first half, speculative investors are now turning to silver and mining stocks for leverage. Silver miners are using 2025's price gains to expand operations and make acquisitions, with some analysts calling it the sector's biggest growth cycle in more than a decade. Earlier this year, the Silver Institute predicted that 2025 mine output would hit a 7-year high, even as silver prices averaged 44% above the levels of the past decade. The silver mining market is projected to reach $42.23 billion by 2032, growing at 8.75% annually. Miners are outperforming, with gold and silver names running hard. So, the big question is whether this is the start of a real safe haven cycle, or is the rally already overextended? Investors should get ready for a massive move. The last gold bull market saw gold surge 7.6 times, and junior mining stocks delivered returns of up to 20 times. London projects gold could hit $8,000 this cycle, fueled by de-dollarization. Let's get back to the interview.
In every bull market, every long-standing bull market of gold, silver has outperformed gold. In my analysis, it's going to do that again because it always has, very simply put.
Yeah.
You know, keep it simple, stupid. It should do that again. You know, there's no sure thing. We're just playing probabilities, and that's a pretty high probability. But the new truism is that gold and silver lag gold, but I mean, miners in silver lag gold. But in the 1990s and 2000s, it was the reverse. It was an accepted wisdom that the miners usually preceded gold on these, especially in these intermediate rallies, because investors saw that coming up and the smart money went into the miners because they expected gold to rise, and were often correct. And not saying there weren't some false moves and false indications in the miners as well, but right now, because the central banks are leading the whole gold story, and it really isn't accepted wisdom that you need to be in gold on Wall Street yet, it's being dragged along. You know, the smart money in Wall Street are trying to react instead of be proactive. So they are being pulled along and now trying to find some way to play this trend, and seeing that gold's gone up so much. The laggards are the way to play it now. And those laggards are the mining stocks and silver, because that's not what central banks buy or have been buying. If I look at the gold price and say that we're about halfway there for where this cycle will take us, yeah, and I'm saying, fourth inning, something like that.
Yeah.
Fifth inning. I would say, but it's the biggest moves, come toward the end. I don't know what it's going to take to get the speculative FOMO investors to buy gold at these prices. I mean, the trend will have to continue.
Yeah.
But I think they're going to go into it looking at leverage and looking at mining stocks and silver. And, silver leverages gold, but you can get silver stocks that leverage silver, so you can stack your leverage. And I am preaching that right and left these days, that these silver stocks, they've moved a good bit, but these junior silver stocks are the most explosive area I see going forward. We had a little run in the spring of 2016, and across the board, they all quadrupled and quintupled over 6 months. Over 6 months, they can move and will move. And again, silver's popped over $40 today on a spot. In the long history of gold bull markets, which for a 4,000-year-old asset stretches back only to 1971. But over that period, we've had 3 previous bull markets by my count, and this is the 4th. But this one's unique, primarily because, really for that very reason, we've had no real corrections other than the one right after the presidential election in the US. Other than that, the corrections have not been of the depth or duration that classic technical analysis would have predicted.
Right.
And my thought is that that's because what's been really driving this bull market has not been the ebb and flow of investor emotions that you see in a typical investment or typical asset, but rather the programmatic buying of central banks who really aren't subject to those, bouts of euphoria and despair that typically drive markets. So the corrections, instead of being steep declines and hitting support levels on the bottom, have just been really pauses in the ascent. Now, that said, this pause has gone on a bit longer than we've seen before, but it's typical seasonality. We in a bull market, the average bottom for the gold price in a bull market is any time from mid-July to mid-August. So that if you look at the charts with and really narrow in, that may have actually held this time. But I think what we're seeing now is not only the summer doldrums relenting, but also really a fundamental shift in sentiment for risk assets, because I look at what Powell did at Jackson Hole as just essentially unleashing the hounds and returning to an easy money environment. And that environment will be very bullish for the monetary metals, gold and silver. I think it's going to be bullish over the short term for all risk assets. But, the stock market is so toppy right now and overvalued that anything can happen there. I think gold and silver are the real beneficiaries here. In the 2000s, the junior mining market was extraordinary in that first off, you had a rising tide was lifting all boats. So instead of your loser in the junior miners losing 50% or more, it might be staying even and might be only going up 50%. And your winners were going up 3, 4x, being taken over, or you would sell, roll it over into another one that would go 4 or 5x. Then every now and then you would have a 10x. Every now and then you'd have a 20x in your portfolio. The most extraordinary rapid buildup of wealth. 2000 to 2011 with a short, hiatus in 2007, or 2008 rather. But it was an extraordinary period to be in the sector. I think we're looking at those kinds of returns again, because we've had, I count the 70s as 2 bull markets, early 70s and late 70s. There was about a 1-year bear market, 75 to 76. And that was pretty severe. Gold went down 50%. So it was, I think a clear bear market. So if you look at the potential for gold, you mentioned earlier that is gold topping out now? Is this as far as we're going to go? We're in uncharted territory here. So I look to the previous bull markets to get an idea of where we could go. In the early 70s, the gold price went up 5.6 times from the low to the high, trough to peak. In the late 70s, it went up 8.2 times trough to peak. In the 2000s, it went up 7.6 times from trough to peak. If you mark the low for this cycle in December of 2015, as I do at like $1,050, that means we'll peak out at somewhere $6,000 to $8,000 range. Now, there are other people interpret it differently. They lump the 70s as one big homogeneous bull market. If that's the case, then you're looking at 24x from trough to peak. Yeah. And that at that point, you get into, are we going into a new financial monetary regime where they're going to back back M2 with gold to some percentage? That's when you can get into those numbers like $20,000, $30,000 gold price. I'm not predicting that, but I'm recognizing a trend here that gold is telling us something. That this gold price has risen because at least the central banks feel there's something ahead. I think that, yes, they want to protect themselves from the dollar weaponization, the U.S. hegemony. That's definitely a big part of it, probably the majority of it. But I think they're also looking at the fiscal situation in the U.S. and indeed throughout the West and developed nations where debts, after 45 years of ever easier money, the debt accumulation has risen to such a level that it's really putting a bind on, structurally on fiscal budgets and will going forward if interest rates remain at these levels.
Silver is reported as the top-performing commodity of 2025, significantly outperforming gold due to its dual role as an industrial metal and a precious metal. Silver crossing $40 is a huge breakout. The last time it was here was over a decade ago. Gold is right behind it, inching closer to fresh records. If history tells us the greatest returns come toward the end of a bull market, are we on the verge of witnessing silver and mining stocks deliver their most dramatic gains yet? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.